Hey everybody, Coach D from TackleTrading.com, wanting to walk you through one of my favorite trading adjustment sequences. It's actually not just a random adjustment, it's a system that I use to help me offset and mitigate risk. So I'm going to start you out with the basic chart setup. And let me go ahead and remove those lines here real quick and come back to those in a moment. Okay, so I spotted this setup coming off of a double bottom in an upward trend, just expecting this MasterCard ink to pop out, and we did. We got a breakout. And of course, there's different ways to take advantage of the price movement makes money. We can buy the stock, we can buy long calls, we can do spreads, I mean, et cetera, et cetera. There's lots of choices, lots of options, if you'll pardon the pun. So let me walk you through my mindset on that and the general idea. So what I did is I started out building a debit spread. And I built a debit spread kind of based off of where the stock price was, where I thought it was going to go, and looked at, the stock price as I looked to put the trade on a couple weeks ago was coming off of here down at 120, and I believed it had a good chance of breaking out and running, but I didn't really expect it to get much past that 130, 135 zone on the high end, because you kind of look at that range, and that's about a $5 range. Whenever stocks break up to new ranges, $5 would be a reasonable expectation in that regard. It did it here. It moved in about a $5 range, moved up into a $5 range, moves up into a $5 range, probably moves up into a $5 range. That's kind of the consistency of the price movement. So let me walk you through the basic spread. So what we did is bought the 125 call because, hey, I expected it to break above 125, but I didn't really expect it to get out past 130. So I bought the 125 call, giving us the right to own the stock at 125, and that cost $2.71. So would have had $271 of risk for the single contract. Not that bad, but I didn't expect it to get too far past 130. So to offset the risk in the near term, we basically brought in 271 and then we sold and brought in. So this was a debit here and this is a credit. And so I reduced the risk automatically by selling it out where I didn't think it was going to go. So that's the basic debit spread. And I went longer term in September so you could see there was time. And that basically gave us a fixed reward to risk profile. The reward, been capped. We capped all gains above 130. That's why this, graph, because you promised to sell it out at 130. You have the right to buy it at 125. And the net, debit on that was $1.61 at the end of the day. So $161, maximum risk, which is reduced from the 271 originally. So you have a fixed risk reward. Risk is 161, maximum rewards 339. Well, you know what? The stock did in fact run up as anticipated, and it's gotten out towards that 130, and it's starting to show a little sign of reversal. And it could keep going, but there's a high probability that it reverts back to the mean. And so, you kind of look back at the number of times this stock has run that many points, and it ran, good 10 points here, and then it dropped back 5. That's kind of Dow theory right there. It ran 10 points, dropped back 5. Here it's, run about 10 points, and it would be reasonable to expect it to drop back 5 and consolidate in that new price range. So again, we have fixed risk, fixed reward. And now that I'm worried about, this is where the stock price is trading today and have a nice little profit here, I'm looking at the chart and thinking to myself, well, it could head back down and give up some of our gains. And, the trade, we've got a little bit of risk in there still, of course. So what I did next was essentially added on a bear call spread and turned it into an iron condor. And did that based off the fact that, hey, it's now gone up 10 points out here, and I'm expecting that to pull back down. Doesn't mean it will, it just means that's my reasonable expectation. And the reason this is a really cool adjustment is check out what it does for a couple things. One, our maximum risk is 161 right now, maximum gain is 339. As I sell the 135 call and collect another $1.15, that did a really good job of reducing the risk, and it brought our risk down to just 46 bucks, but it leaves us naked on the top, which you can do, and I'll do that from time to time. But I just wanted to make sure I also kept the margin requirements really low. And so I went and out of the $1.15 we brought in, spent 38 cents on the 140 call. I don't think it's going to 140, but I just wanted to have the trade kind of, close ended in the condor rather than being naked. So we now have a maximum risk of 84. So maximum risk is less than 100 here. We've got $84 risk. and we got a maximum reward now of 416. We bumped the ceiling up to $416 maximum reward. So $84 risk, $416 reward. That's way better than a 4-to-1 ratio. So that's pretty solid. And now anything between 139 and 126 is going to be profitable. Anything between 135 and 130 is going to be maximum profit. And so really what I'm expecting this stock to do, and we have clear till September, is between now and September, I'm expecting it maybe, hey, pull back down in here, old support become resistance, maybe hang out in this neighborhood, and then if the market continues to stay strong, we'll see it break out into that new neighborhood. And I don't expect it to get past 135 because that would put it at another 10 points from 125 to 135. So, whether or not that plays out that way or not, for all I know, the stock ends up, double topping in here and then dropping. That could certainly happen too, but because I've reduced my risk to just 86 bucks, whoop-de-doo. So if you like the idea of no more than $6 risk and 400 plus $416 of potential reward, and just doing that in 2 trades, I started out with the bull call spread, and as the stock price got up, I added on the bear call spread, and I now have a pretty fat Condor. Coach D, TackleTrading.com.